Welcome to vTalkInsight Allocator's Lens Daily for February 19th, 2026. Today's cross-asset picture is defined by a powerful AI and productivity upswing colliding with a higher-for-longer rates debate, while geopolitics cools parts of the commodity complex and central bank politics heat up in Europe and the UK. Let's start with how that mix is reshaping the equity landscape. In equities, the macro backdrop still looks remarkably supportive even as leadership keeps rotating. Recent U.S. data point to subdued inflation around 2.4% despite tariffs, while real wages are reported to have risen by roughly $1,400 per worker over the past year. Productivity growth near 3% and estimates of aggregate supply expanding closer to 5% underpin forecast for U.S. GDP running in the 3 to 4% range, with some expecting even stronger prints in coming quarters. That combination of contained inflation, rising real incomes, and solid growth supports the revenue and margin picture for listed companies. We see that in the S&P 500, where corporate margins have reached record highs and earnings have delivered double-digit growth for 5 consecutive quarters, helping to justify current valuation multiples even as discount rate expectations edge higher. AI and data center investments sit at the heart of this equity narrative. A surge in AI and infrastructure capex is driving broad-based capital spending and contributing to higher real revenues and margins at the index level, suggesting productivity gains are starting to show up in the macro data. At the same time, concerns are building that this may resemble a capex bubble, with questions about whether the U.S. power grid can sustain the projected AI build-out and whether spending has overshot near-term demand. That tension is visible in price action. The S&P Software Index is down about 20% year-to-date, and sector ownership is at multi-decade lows. Yet, underneath the drawdown, technology earnings revisions have outpaced the broader S&P 500 by roughly a factor of 3 over the past 4 months, and software platforms that provide AI infrastructure, such as large cloud and data players, are seeing strong growth while trading at historically low cash flow multiples. Stock-specific stories highlight how concentrated some of these themes have become. Meta's multi-year commitment to deploy millions of NVIDIA AI chips, including the new Blackwell architecture, could generate more than $16 billion in revenue for NVIDIA and reinforces its dominance in AI accelerators. Those Blackwell systems are reported to deliver around 30 times greater token output per unit of power, further extending NVIDIA's edge and putting pressure on rivals. We have already seen competitors, such as AMD and Arista Networks, sell off on fears that NVIDIA's expanding role in both GPUs and data center CPUs could erode their market share. Elsewhere, dispersion is high. Bookings slightly better than expected results met a muted share price reaction after a sizable year-to-date decline, while Palantir was upgraded on strong revenue growth and margin expansion, and some defensive names like American Waterworks are being highlighted for steady earnings and dividends after pullbacks. Despite the headline noise, equity breadth has improved meaningfully. Around 65 to 70% of S&P 500 stocks are now in uptrends, and roughly 70% trade above their 200-day moving average, reducing reliance on the so-called Magnificent Seven and pointing to a healthier market structure. Equal-weighted and small or mid-cap indices have nearly matched cap-weighted performance since the latest rotation, and both developed and emerging market equities have started to outperform after a decade of lagging U.S. benchmarks. In Europe and the UK, indices with more exposure to commodities, financials, and cyclicals are attracting flows. The FTSE 100 has pushed to fresh record highs, helped by strength in defense and mining names such as BAE Systems and Glencore, while basic resources overall are leading European gains even on mixed earnings. In Asia, Taiwanese and South Korean semiconductor leaders are seeing AI-related exports surge, with some firms growing market share at rates approaching 80 to 90%, and Taiwan's chip exports reportedly up about 30% this year. Sentiment, however, is moving toward an extreme. A major fund manager survey now shows the most bullish positioning since 2021, built on expectations of strong profit growth and a global soft landing, while projections for the S&P 500 point to levels around 7,300 to 7,600 by year-end. That optimism sits uneasily alongside deteriorating technicals. The index has been roughly flat for 3 months, hovering near its 200-day moving average, and the main U.S. volatility gauge is trading around the high teens to 20 area. The bull market is increasingly predicated on AI delivering sustained productivity gains. If that promise disappoints, both positioning and sentiment could unwind quickly. Allocators are therefore balancing powerful earnings and growth tailwinds against concentration risk, potential AI capex excesses, and more volatile price action. Those questions about discount rates and growth bring us straight to the rates market. Rates markets are wrestling with the idea that stronger trend growth may lock in higher real rates, even as headline inflation moderates. Recent quarters have seen U.S. GDP running above 3.5% annualized, and forecasts for the next 12 months cluster around 3% with upside toward 4%, helped by AI tailwinds, easy financial conditions, and delayed fiscal tightening. Productivity gains from technology are leading some policymakers to argue that the equilibrium real interest rate has moved up, meaning nominal policy rates may stay elevated even if inflation edges lower. Fed minutes and recent commentary show most officials still expect disinflation to continue, but warn that progress toward the 2% target could be slower and bumpier, with upside risk from tariffs and planned price hikes. A minority on the committee is now openly discussing the possibility of renewed hikes if inflation re-accelerates, while several members stress a higher bar for cuts. That challenges earlier market hopes for multiple rate reductions this year and increases uncertainty around the timing and scale of any easing. In the UK, the rate story is a tug-of-war between weakening activity and sticky services inflation. Softer wage and labor market data, including youth unemployment at a 10-year high, have triggered a rally in gilts as investors anticipate a more dovish Bank of England stance. Markets now assign roughly a 3 in 4 chance to a bow cut as early as March, and see headline inflation dropping back to around 2% by mid-year thanks to government measures and favorable base effects. Yet services inflation printed at 4.4% versus a 4.3% forecast, underlining that underlying price pressures remain persistent. Some forecasts suggest the bow could cut by around 75 basis points over 2026, more than is currently priced, because of softer growth and deteriorating labor data, while others argue that markets are underestimating the persistence of UK inflation and that the terminal rate may remain above 3% even with early cuts. That wide range of plausible paths keeps the UK curve highly data-dependent. Across the channel, attention is turning to the European Central Bank and what potential leadership changes might mean for rates. Speculation that President Lagarde could step down early has intensified, with several hawkish candidates mentioned as possible successors. If a more restrictive-leaning president were appointed, markets might start to price a tighter policy stance, which could push euro area yields higher and weigh on regional risk assets, even as the bloc continues to grapple with below-target inflation and the risk of a disinflation trap. Concerns about central bank independence are also creeping into the discussion as political maneuvering becomes more visible in both Europe and the UK. For a multi-asset allocator, the message from rates is that traditional duration hedges are back in play, but the scope for large policy-driven rallies is constrained by stronger potential growth and a cautious central bank reaction function. Credit markets, especially at the high-quality end, continue to paint a benign picture that aligns with the soft landing narrative. Global investors are showing strong demand for investment-grade corporate bonds, with large new deals, including recent issuance from mega-cap names like Alphabet, being readily absorbed. Investment-grade indices are trading near all-time tights, and primary markets remain wide open as firms lock in funding. That environment benefits franchises such as S&P Global, whose fixed income ratings business is expected to gain from increased issuance activity. Credit availability for middle-market borrowers also remains robust, with limited evidence of lenders demanding significantly wider spreads despite ongoing geopolitical and trade uncertainties, which in turn supports continued business investment. Beneath those strong surface conditions, however, there are growing worries around non-investment grade and private credit. Expectations are building that the next credit cycle will produce significant dispersion in returns among private credit managers, particularly in loans tied to private equity-sponsored companies. Some large alternative managers have already positioned for that outcome. Apollo, for example, has deliberately kept minimal exposure to software and tech-focused private credit because of disruption risks, preferring investment-grade-oriented strategies they see as more resilient if economic conditions or AI adoption patterns change. Recent equity market weakness in listed private credit vehicles has been attributed more to general risk reduction than to idiosyncratic problems. But it serves as a reminder that this growing part of the system is sensitive to both valuations and liquidity. Household and company-specific credit signals add another layer of nuance. In the U.S., middle-income households are seeing a marked slowdown in spending growth compared with higher income groups, the widest gap since early 2022 as affordability pressures build. Forecasts from the National Foundation for Credit Counseling suggest household financial stress could reach new historic highs by the first quarter of 2026, particularly for consumers in their 40s and 50s, even though larger tax refunds may provide only temporary relief. On the corporate side, cases like Bayer's potential multi-billion-dollar litigation payout highlight how single-name credit risk can flare up even against a broadly supportive macro backdrop. For allocators, the credit story is one of tight spreads and abundant liquidity in investment grade, offset by rising tail risk in leveraged and household balance sheets. Foreign exchange markets are increasingly expressing views on relative policy paths and growth rather than a simple risk-on or risk-off trade. A weaker U.S. dollar is anticipated over the coming year, with forecasts of roughly a 5% decline in 2026 following a 10% drop last year. That outlook is tied to expectations for eventual Fed easing and firm global growth, which together tend to support non-U.S. assets and commodities. However, the Fed's recent emphasis on a higher bar for cuts and renewed concern about inflation mean the dollar's downtrend may be punctuated by periods of consolidation or even counter-trend strength. For the euro, further Fed easing and dollar softness would normally be supportive, but there's an added complication. Euro area inflation is already below target, so a stronger euro could exacerbate disinflation pressures and push the ECB toward a more dovish stance unless leadership shifts in a meaningfully hawkish direction. Sterling faces a different mix of challenges. On one side, markets continue to price an early Bank of England rate cut, with a high probability assigned to March action and further easing expected as growth slows and the labor market softens. On the other side, UK core and services inflation remain elevated, and some analysts argue that markets may be underestimating the persistence of price pressures and overestimating how low the terminal rate will fall. Layered on top are rising political uncertainties ahead of UK elections, including debates about changing the Bose mandate and concerns over central bank independence. That cocktail of rate ambiguity and policy risk leaves sterling vulnerable, particularly against currencies backed by relatively tighter policy and strong commodity dynamics, such as the Australian dollar. In Japan, signals of greater fiscal restraint after elections have tempered expectations for a sharp near-term appreciation of the yen, even as markets still look for a notable drop in dollar-yen later in the year as domestic policy slowly normalizes. Across Europe, speculation around ECB leadership changes and the potential for a more hawkish successor to President Lagarde is creating short-term euro volatility, but could eventually support the currency if markets come to believe that policy will be more restrictive. More broadly, investors are paying closer attention to how political dynamics shape central bank mandates and independence, from the ECB to the BOE and the Federal Reserve. For a global portfolio, FX is becoming a key channel through which these policy divergences and commodity trends play out. Commodities round out the cross-asset picture, starting with energy. Progress in U.S.-Iran nuclear negotiations has led to a sharp decline in oil prices, as markets increasingly price the possibility that sanctions could be eased and supply risks in the Persian Gulf may diminish. Both Washington and Tehran appear motivated to avoid outright conflict given the risks to regional stability, energy flows, and their own domestic vulnerabilities, which supports the idea of continued talks even if the path remains bumpy. At the same time, Japan's commitment of up to $36 billion of investment into U.S. oil, gas, and critical minerals, including a major gas plant in Ohio and an export facility on the Gulf Coast, signals deepening energy ties and a significant boost to U.S. energy infrastructure and related equities and jobs. Industrial metals tell a more mixed story. Copper's long-term fundamentals remain tight because of electrification and grid investment, yet recent high prices have dampened demand, particularly from China, leading to rising inventories and softer spot prices. Glencore illustrates this push and pull. The company's full-year adjusted EBIT slightly beat expectations, helped by strong copper prices and a rebound in copper production. But overall profits still fell around 6% as a sharp drop in coal prices dragged results. Despite that earnings decline, investors have welcomed Glencore's roughly $2 billion shareholder return and the fact that net debt came in well below forecasts, underscoring how balance sheet strength and capital returns can support mining equities even when commodity pricing is volatile. Precious metals are caught between speculative fervor and powerful structural demand. Gold surged to a record above $5,500 per ounce in late January, fueled by strong speculative inflows. But that rally is now seen as having overshot, leaving the metal vulnerable to corrections. Silver tracked gold higher, but with even greater volatility, reflecting its smaller market and lower liquidity. Yet, unlike gold, silver has a pronounced industrial role. Demand is accelerating from AI data centers, advanced semiconductors, solar panels, and emerging solid-state batteries, with no clear substitutes. The U.S. imports roughly 64% of its silver needs, and the metal's recent designation as a critical mineral has prompted stockpiling and fresh attention to supply chains. Most global production comes from politically riskier jurisdictions in Latin America, making U.S.-based projects more likely to command valuation premiums as generalist and institutional investors increase their exposure to precious metals and mining equities. Stepping back, today's cross-asset picture shows a powerful growth and earnings engine meeting a more constrained, higher-for-longer rate environment. Equities benefit from robust U.S. and global activity, broadening leadership, and an expanding AI ecosystem, but they are increasingly dependent on productivity, gains materializing at scale, and on central banks avoiding policy mistakes. Rates markets reflect that tension, with U.S. policymakers cautious about easing into strong data. The bow pulled between sticky inflation and softer labor conditions, and the ECB navigating both disinflation risks and leadership uncertainty. Credit remains well supported at the investment-grade level even as private credit, leveraged borrowers, and middle-income households show rising pockets of stress. In FX and commodities, expected dollar softness, European and UK political risks, easing oil premia, and structurally tight critical metals like silver all feed back into the macro regime that allocators need to monitor. The key watch points now are the durability of AI-related capex, the path of inflation under ongoing tariff and wage dynamics, and how central bank politics intersect with growth. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.